Certified divorce financial analyst and JD Karen Sparks provides clients with focused analysis and strategies for marital asset division. She provides her services relating to divorce and separation matters to clients nationwide. Ms. Sparks is the principal and owner of Divorce Financial Strategists and is a trained and certified financial neutral expert with a unique blend of expertise in family law and the allocation of marital assets. Her client collaboration includes asset analysis affecting child and spousal support, retirement benefits, investments, stock options, Social Security, real estate, tax implications of marital property trade off or buyout, and many other areas of asset distribution, including post divorce matters. She has been a retained expert and trial expert witness for clients on the subject of marital standard of living. Key areas of emphasis during client engagements include, but are not limited to, working with clients to establish financial goals, establishing current budget requirements and setting priorities for post divorce budget practices, determining support requirements and tax implications for retaining or selling various client assets, and reviewing certain foundational documents such as pay stubs, tax returns, bank and investment statements, business records, credit card statements, credit reports, and other materials in order to create projections for marital settlement proposals and guiding clients in identifying and finalizing specific post divorce tasks relevant to their situation. The ultimate objective for divorce financial strategists is to assist clients in establishing financial strategies for successful living. Ms. Sparks provides financial consultation regarding divorce and separation to attorneys, individuals, mediators, alternative dispute resolution professionals, and other family law service providers. To schedule a consultation or for additional information, please feel free to contact Karen Sparks by phone at 650 201 6311 or by email at cdfa at divorcefinancialstrategists.com. In addition, her website is divorcefinancialstrategists.com.
Hello, everyone, and welcome in to our presentation time today, where we're going to be focusing on a major issue in the journey of disillusion for families. And that is the preparation and process regarding the Marital Standard of Living Analysis Report, which is conversely known as a lifestyle analysis. My name is Karen D. Sparks. I am a certified divorce financial analyst. And in my work with families in my practice, which will be coming up on 10 years next year, the focus of my work has been to support counsel and other family law professionals in the area of allocation, valuation, and strategies involved with what is financially in the marital bucket for families going through dissolution and divorce. A major area of challenge and discussion is one of spousal support. That, together with real estate and perhaps retirement assets, are the three major areas where there is a lot of challenge in coming to decisions on how the payments and the allocations are to be made. In the area of permanent spousal support, it really is mission critical and prudent to make sure that a lifestyle or marital standard of living analysis is done, as this is normally the grounding point for the parties, for counsel, and related family law professionals to begin the discussions on what the actual figure should be for the paying spouse who is going to be paying permanent spousal support for whatever period of time is designated by statute in the jurisdiction where you're practicing. And so the inputs into this type of work are extremely detailed and extremely important as they are going to guide the income objectives for the receiving spouse and set the boundaries for the payor spouse coming out. And so while there are many issues attached to this, today we're going to take a look at a few of the more unusual ones or boutique issues that are starting to come to the fore, definitely in my practice, and would be important to know should they appear in some of your dissolution conversations with your clients. So, to that end, let's take a look at how we will come through our discussion in this session. So, first, we're going to focus on simply the nature of defining what it means to have marital assets distributed. We're going to look at two main approaches that come into play there, and we're going to take a look at just two sample guidelines that represent those two approaches. Then we'll move into an overview, really, of marital standard of living. And for our time today, I'll be interchangingly referring to it as the MSOL report or marital standard of living. We'll talk about what is it? What are some of the key factors that go into the calculation by professionals who prepare this type of work? Finally, we're going to really get into navigating these financial issues, and we're going to focus on a couple of data points involving investment assets. We're going to be talking about real estate in terms of income disparity, in terms of how the marital and separate property components of that come into play for impacts on real estate there. And we will round out our discussion on the issue of deferred compensation and talk about how the distribution of income under that model of saving and investment has an impact on leveling the marital standard of living analysis process. So when we look at the subject of how marital assets and distributions are made, there are two main points of view, if you will, across the United States on how this subject is handled. And the two main areas are community property designations and equitable distribution designations. As you can see from the map here in front of you, the dark purple states are those that adhere to the community property concept of marital allocation, and the lighter purple states, which are the majority of the states here in the United States, follow the the equitable division guidelines. And so, just by way of information, I wanted to just provide an overview on a definition for those two. So for community property states, which of course include Arizona, Nevada, Washington, Puerto Rico, and even though Puerto Rico is a U.S. territory, please note that they do follow the community property laws and designations. So for those states that you see listed here under the community property states, the overriding principle with that point of view is that the marital estate is divided 50-50. Everything that has come into the marriage during the term of the marriage is approached from that point of view. That said, there are times when perhaps that designation, that percentage designation needs to be shifted a bit depending on which assets the spouses are choosing to maintain and retain. But in general, the overriding principle with community property is everything is divided 50-50. You can contrast that with equitable division states in which the approach is a little bit different. It is not an application of a defined standard or percentage in how the assets are going to be allocated and divided. Instead, the approach is one of equity, if you will, to use that same term, but in meaning there is a wider approach to how the assets are going to be considered, and there's also a slight difference in the type of assets that are considered available for distribution and available for valuation in the equitable division standard. So those are the two main points of view that we deal with in the United States in the family law sector. And so, by way of example, I wanted to discuss two sample statutes that illustrate the principles for both community property and equitable division or distribution. So the first example that we're going to look at is a statute from California. It is Family Law Code Section 4320. And we're going to take some time to just walk through a few of the main components of that statute to give you a window into how some community property states tend to approach the issue of allocating the marital estate under this context. So, obviously, the first and most important thing is to focus on earnings, and this is ability to maintain the standard of living. We're going to be talking about some of the inputs that are involved in discussing income, but in general, one of the major focuses under this statute is to really segment out and identify all of the income initiatives that could be affecting the family. The second issue are contributions that are made by spouses to the education of either one or both spouses. And this is in an attempt to try to put a value on the work that has been done, for example, by the spouse who maybe is a lower wage earning spouse or now the no wage earning spouse. But prior to that, they have contributed to either graduate education or some other contribution to career advancement so that the other spouse could move ahead with their objectives, with their life objectives. The next focus that is generally approached under this particular example statute, we're taking a deep dive into assets, debts, and needs. And again, this is a cornerstone of the preparation of the Marital Standard of Living report and all of the data and statements and inputs and other essential data are involved in this part of the analysis as well. Under the statute, we're also looking at age, and this is an important clarification at this point in terms of retirement, in terms of the timing of certain things in terms of health. We're also looking at the quality of the relationship, if there's been any abuse or addiction. We're balancing the hardships, and that is a key component of this statute and looking at how the scales are leveling in between what each spouse is going to be having to do or having to receive or having to adjust to. Also, there are issues of the custodial parent, if they're going to need to work outside the home. What does the employment of that look like? What does the care of the children look like? Another key component is the duration of the marriage. And under this concept in the state of California, there are guidelines that are generally followed in this respect in terms of segmenting out the difference between perhaps a short term marriage and a longer term marriage. A shorter term marriage is a marriage that's usually been under 10 years. And the way that this statute tends to deal with that issue is that marriages under 10 years, they're generally looking at support for half the amount of the marriage. Over 10 years, we're considering that a marriage of long standing. And therefore, the length of the support could definitely be the full length of the marriage or some other agreed upon time. But generally, anything over 10 years is considered a marriage of long standing. Also taking a look at the tax consequences of support, and we'll be talking about the Tax Reform Act of 2017 a little later in the presentation, and of course the relative hardships there. Finally, there is an overriding principle within this statutory guideline that we're using, Family Law Code Section 4320, for the receiving spouse to look at becoming self-supporting within a reasonable amount of time, keeping in mind what is going to be needed in order for them to re-enter the workforce in order to be gainfully employed. We want that point of view to be just and equitable. And of course, if there's any issues of convictions or any type of challenging behavior in the marriage, we're taking a look at that. The important thing to note with this particular example statute is that in looking at permanent support and in looking at any professional report that's done, such as a marital standard of living analysis, the court must take a look at any and all of these requirements to see how they intersect with it in order to make an appropriate ruling as to what would be appropriate for the family in this case. So let's take a look now at an example statute for equitable division or equitable distribution. Like the community property statute, length of marriage is an important issue. There's also could be a reference to any financial issues coming out of prior marriages that one or both of the spouses might be responsible for. And here in this example section that we're using from Pennsylvania, there's section 3701, looking at a broad range of sources of income, including retirement income. And this is important as the timing and ability to receive support for spouses that are near or approaching retirement could affect the length and time, depending on the statutory guidelines in the jurisdiction where you practice, for the receiving spouse to receive that income. And that type of information is definitely factored into the marital standard of living analysis. Of course, a cornerstone of age, of health, of actual workforce skills. How does that play with both spouses? What is the timeline or the trajectory for the particular area of expertise that the person is working in? How does age affect that and their ability to be viable in the workforce? The next focus would be the opportunity to actually make the income contributions to the marital home. And earlier, when we went through the presentation on what we were going to cover today, I did refer to real estate. And in that, contributions to the marital home can involve income that was used to purchase that home and payments toward that home. And we'll be discussing that as another matter as we move forward. And of course, the standards of living during the marriage. There's also a look through the prism of the value of property of each party. And this could include separate, what we in community property states refer to as separate property assets. It could include that. It also focuses on the economic circumstances after division, including any tax benefit, costs that may be involved for selling any type of marital property, etc. Finally, similarly to the community property sample statute, whether a party will serve as a custodian for any of the dependents. And I do apologize, I see there is a typo here on the word party, but who is serving as a custodian and what is that going to mean in terms of time and income for that person performing that task? So this is just two windows into sample statutes. Of course, these could differ and vary depending on government prescriptions and statutory prescriptions where you are. But in general, these are some of the key components that you might find in a community property statute or in an equitable distribution or division statute that you would be dealing with. Now, the important thing to understand is what is a marital standard of living report and what exactly are the factors that give rise to it? What type of work product is produced and how is it produced? So the simple definition is the lifestyle enjoyed by the parties during marriage. It is a simple statement that has a lot involved in it. And as you can imagine, you're dealing with a number of factors, and what you're seeing on your screen right now are some of the key areas that are normally focused on. Obviously, schooling. So you would start with there if any minor children, education imperatives, uh, private school, public school? Does there need to be any type of tutoring or either help with that? It could also include education being taken on by one or the other spouse. Maybe they're furthering their education during the course of the marriage, and we have to look at those costs and how that's impacted income. Of course, housing is a major, major focus depending on where you are in this country. Certainly, the cost of it, the maintenance of it, and whatnot are key factors in determining how the marital income has been dispersed in that regard. Discretionary actions such as shopping and dining out and those types of things. I know that when I am going through my data and my documents in this regard, looking carefully at the percentage of discretionary spending versus spending for main living expenses such as mortgage and taxes and insurance and whatnot, and looking at the proportion of how that's being done. and vacations. And certainly last but not least is the income component. And I'm going to be talking to you in just a moment about some of the inputs that are important to consider in that regard. But when you're looking at the nature of MSOL, we're focusing on the family's lifestyle, how they lived, and how they made that happen in those three components. In my work, in going through all of the data, electronic and paper form involved in putting a report of this type together, I have developed a organizational journey that is very key to making sure that you stay on top of all the key information and you're able to therefore organize it and track it in a way that makes sense and allows the report to flow from asset to asset in a way that is understandable and interchangeable if necessary when you're going. So I've actually divided the approach in three ways: core, liability, and asset. So I'm going to come through each one of these spheres to show you how they work alone and how they can intersect as well. But they are good, if you will, division points and access points for making sure that the analysis stays on track. So in the core sphere, the very first documents that are key for revision are whatever the initial filing documents were for the parties in the jurisdiction where this matter is being handled. It's divorce petition, summons, whatever the initial forms and documents that the court is requiring, you want to take a look at that. Why? That has a lot of basic information for the parties, their date of marriage, potentially their date of separation, how many children they have, the length of their marriage, and so on. Whatever the requirements that the form requires, a lot of some of that basic statistical information is included there. And so that's usually a basic starting point in your analysis. The next document is any type of disclosure, any type of income and expense or asset declaration worksheet. This is important for beginning to set the foundation for starting to sort out the specifics of how the family actually handled their day to day living. And key there is taking a look at the types of expenses. Normally, this includes line items for child expenses, utilities, things of this nature. There are usually designations within that document to talk about any type of additional income, bonus income, commission income, that type of thing. So that document is also very good in beginning to set your base. A document that I utilize for the most part in my practice quite a bit is taking a look at the credit report for both parties, because oftentimes all of the statements and documents that are reviewed in the process of the MSOL report may or may not track some items that are showing up on the credit report. And so the credit report will be detailing any type of activity that is impacting the marital income in whatever way possible, usually in a debt situation or in an encumbrance situation. But whatever those may be, they almost 100% show up on a credit report. So you want to actually use that document as a cross reference, and I do in my practice as well. Tax returns, W-2 statements, and the like, K-1s, all of these provide a deeper insight into a lot of the transactions that are actually going on in the particular marital estate. I will say that when you're looking at, and finally with bank statements as well, when you're looking at some of these core documents, one of the things to keep in mind is to make sure you're getting enough of a history. Statistically, it has been shown that on average, an individual considering divorce has been thinking about it for at least 2 years. So, with that in mind, there are often actions that are taken, transitions that are done, money that is moved 3 to 5 years prior to the date an actual separation occurs for the parties. So, one of the key things is to make sure you're seeing enough of that history, or the professional you have preparing this report sees enough of that history in order to really be able to establish what the marital standard of living is. So after you have pulled together all of these key documents, and I should say that everything that you're seeing here is by no sense exhaustive or exclusive. All of these things will sort of expand and contract depending on the size and requirements of the case that you're working on. But these are certainly some of the main things that I've come across over the years that I think are important to make sure that are not forgotten. So after we've dealt with the core, I move to liability documents. So looking at any personal loans that the parties have taken out during the marriage, and also looking at the issue of student loans, which is a huge impact on marital income, is a huge factor for a large majority of our population today with the rising cost of attaining education and or graduate education. This is a debt that normally follows individuals into their married life and becomes an obligation that the community in most cases ends up paying for either one or both parties. So again, this is an income liability factor that I'm looking at. Any type of encumbrance on real estate, in addition to mortgage loans, which are listed at the bottom of this sphere. Looking at any type of encumbrance, personal lines of credit, HELOCs, anything that requires an obligation in addition to the regular mortgage payment. It is important to know what that is because, once again, that is an income impact data point. Credit card statements and credit reports are two of the things that you can cross reference with the other data that you have. They fall into that category. In the credit card statements, you have a sense of the type of spending that's being done, how often that's being done. It's usually you have an ability to categorize a lot of those expenses and really get more of a deep dive insight into the ebb and flow of how money is being spent. Margin loan statements I incorporated into my liability sphere 2 or 3 years ago as a result of a case that I had with a C-level, with the family, with the husband was a C-level executive. And my initial review of their financial situation disclosed on paper that their standard of living was at a mid to high level, I would say. However, upon closer review and looking at some of the investment statements, it became clear that a lot of the income was leveraged and a lot of the lifestyle was financed by accessing the family's investment assets and really sort of, if you will, hedging stock market transactions against them. And if there wasn't enough money in the stock portfolio account to cover those transactions, then what investment firms will do is they'll do what they call a margin call, and thus you're going to have to come up with the loss. So if the transaction you did based on the fact that you could probably make a gain from it. If that doesn't happen, there's a margin call and therefore you're having to consistently use funds to pay that. And so that had a large impact on really the family's actual standard of living as opposed to what you might have seen, for example, in a W 2 or a tax return. So it's just important to be able to be flexible and to cross reference and intersect a lot of the work that's going on to make sure that you're getting an adequate picture. And I frequently cross reference these details. Now, our last sphere has to do with some of the items that would definitely be considered an asset in the marital estate. So, any type of stock benefits, for example, employee stock option plans, ESOPs. We're going to be talking about deferred compensation, which is another method of providing a savings for income, and that I'm going to explain why that impacts the marital standard of living when we get to that topic. Also, there's situations in which trust income is coming in for one or both parties. And so, what is the duration of that? What is the amount of that? How is that impacting the budget in any way, shape, or form? Vested, non vested option income. And we'll look at two examples of that coming up. And retirement vehicles, 401ks, IRAs, SEP IRAs. You're looking at the valuation of those in some cases and looking at when those monies were earned, were they earned entirely within the marriage? Were they earned prior to the marriage? Some earned prior to the marriage, some earned in the marriage. You're going to need to do oftentimes some analysis on that if you have a mixed contribution cycle for those funds. So, this is a way of bringing together the information in a form that allows the analysis to be done and to flow, and for you to be able to cross reference information and know how it intersects in a way that will produce good information, not only for counsel, but for the court as well, if this becomes a litigated matter. And I will say, in my engagements where I have been a retained expert and an expert witness at trial, this has been an excellent presentation tool for myself in terms of dissecting my report for both the judge and for the parties involved as we're litigating marital standard of living. Now, at the start of the presentation, I was talking about how we would expand on the concept of income. Now, both the sample statute for community property and the one for equitable division and or distribution both had earnings and income at the top of the list. And therefore, this is obviously a major player in this analysis. And so what I'm going to do is start from left to right, clockwise. This does not have an order of importance to it, but what this tree does represent, again, is some of the more frequent patterns that are involved in your considerations for determining income available for support. There are a lot of different things that sometimes will be playing into it that you don't see here, but these are the keys. And it is really important to segment out as much as possible all areas of income that could be impacting your clients in this respect so that you don't miss anything. Because again, the purpose of this report is to be able to provide a verifiable foundation tool for establishing the permanent support number in conjunction with whatever statutory requirements apply in your jurisdiction so that the parties have a sense of where they need to go from here. And they have that based on adequate data. So let's start at the left with imputed income. If you are a professional in a jurisdiction that does not deal with this particular type of situation, I want to just take a moment to talk about that. So, imputed income is the scenario in which the spouse who is either the low wage earning, non wage earning, or what have you not, we take a look at what that individual is what their ability is. Normally, this is determined by engaging a vocational evaluation expert who will generally meet with that person over a period of time and take them through some diagnostics to identify and highlight their areas of strength, their areas of weakness for those spouses who were educated in a certain way and actually worked in and around their career, either prior to getting married and even a little bit into the marriage, or maybe they came in and out of that on a part time basis during the marriage. This will again establish how much that person could probably make and what their ability is to maybe re-enter the market, what skills are going to be necessary for them to re-enter the market, and what the outcome of that particular report is to determine whether a salary of some sort can be assigned to the receiving spouse. That number that is input into that calculation will then very much affect the amount of spousal support that the receiving spouse will get. And oftentimes, this is a very highly charged conversation, as there are oftentimes statements made or conversations had, particularly from the spouse that's going to need to pay, that the receiving spouse has a degree in a certain area. They should, with a little bit of help, maybe with some coursework, just be able to immediately get back into it. And one example that comes to mind is a case that I worked on and was retained as an expert for a couple of years ago, 2 or 3 years ago, wherein both husband and wife had achieved both undergraduate and graduate degrees in the STEM field. Husband had continued to advance his career both in starting his own company and also being as a tenured faculty member at a university in this particular area of expertise. The wife in that particular case was highly educated as well prior to the marriage, worked a little bit in the industry, and then it was their agreement that she would stay home with the children and raise them, and the husband would go ahead and continue to be the major wage earner. Well, the big issue on deck was that husband was of the mindset that because she graduated from an Ivy League school, she had graduate degrees, she should be able to, with just a little bit of help, come into the market. However, she had been out of the market for at least 15 years. The research that was a part of my report really indicated that due to the exponential rate at which technology advances and the age at which she would be reentering the market, which was essentially her early to mid 50s, that the data and the research did not really support. Um, the husband's expert assert he had an expert as well. I was hired for wife, and husband hired his expert as well. But his expert had indicated that she should be able to come back in, but all the data indicated not. So that was a case in which husband was trying to really impute a level of income to wife that did not really line up, A, with her skill set at this point, and B, didn't really line up with the new interest which she had developed in writing and producing children's books. So that's an example of imputed income. Deferred compensation, we will talk about it. But in general, you're wanting to look at how the deferred compensation plan was set up, how the income was deferred, and is that income even available for us to even talk about in the marital bucket? And I'll get into more detail in just a few moments. Bonuses. This is another hot button issue, and quite frankly, there is a lot of strategy involved, particularly in the spouse that's thinking about getting a divorce but hasn't communicated that to the other individual in the timing of bonuses, um, how bonuses are derived, how often bonuses are received. In some jurisdictions, there is statutory language that bonuses are also folded into calculations for child support and whatnot. So, this is an area where you have to be a little nimble and you have to be looking really closely at when transactions are happening, how that relates to date of separation, when was it earned, how was it earned, and whatnot. And sometimes that does require looking at additional documentation that is produced by the client. Now, commissions are a cousin to the bonus discussion. And the outlook for commissions is a little varied. One of the things that you have to be careful with commissions is assigning an average income, if you will, to the payor spouse that is beyond what they're actually really able to do. Commission income, when it is a major part of a wage earner's salary, can have many variations to it. The timing of payout is important, and you have to actually look at a trajectory and a history with it, which lines up with my saying previously that you need to have some time looking backwards into the family's history because you need to see how that's lining up so that you can apply the correct modality to analyzing the commission income and how that really relates to that person's total salary. Another area which can come up depending on statute and case law is taking a look at separate property distributions. And what that actually means is that if one of the spouses has been awarded, shall we say, certain investment assets that do provide a rate of return, in some jurisdictions, there is statutory and case law which allows the income from that rate of return to be included in the income discussion and the income calculations. And so if that is the case where you are, that's something that you'd want to pay attention to. Early retirement is another area that's coming on. I've seen it more and more frequently in my practice. And how this relates to the marital standard of living and the income discussion is as follows. Particularly if you're in a jurisdiction which looks at marriages of long standing in terms of how long the receiving spouse is going to have income. If you're dealing with a family, for example, in mid or late life divorce, where perhaps the payor spouse is closer to retiring than not, or maybe they're going to retire a little earlier than the norm. This can and does have a direct impact on the receiving spouse, even if it's been a long-term marriage. If there is not that much time on the clock between the end of the marriage and the start of the retirement, this then has an effect on the conversation on how that income is going to be derived. There are some jurisdictions in which there's statutory and case law which limits the obligation of the paying spouse to provide spousal support beyond their actual official retirement date. So early retirement can have an impact on the conversation depending on what that early retirement looks like and depending on how the family is resourced and what's in the marital estate. Point being, make sure that you're looking at these key assets as well as anything else that's popping up in your analysis to make sure that you're not missing any items of income that need to be done. And this is true also if you are engaging an expert to prepare this report. You want to make sure that they're covering these issues as well if you're not going to be doing that on your own. So now that we've set the background for the type of approach that's made to division of marital assets, what exactly is involved in journeying through the foundational elements of a marital standard of living analysis, and finally, how we look at income. Let's now take all that information forward now as we move into a discussion navigating some of these complex issues that do come up in the discussion. And we're going to start with the area of investment assets. As you might be aware, there are a number of variations and variety in the investment asset discussion. Today, however, I'm choosing to focus on restricted stock units and stock options and to talk about some of the important aspects of those and how the breakdown of those and the valuation of those again comes into the subject of determining income and determining marital standard of living. So to start, it's important to just look at some general overriding principles, and then we're going to kind of drill down a little bit in terms of what this means in specifically for these two particular areas of assets. So for restricted stock units, it's important to understand when that value is being assessed, and the fair market value of restricted stock units are assigned at the time that those stock units become vested. And I will talk about that in a minute, but this is just an overriding principle. Stock options represent the right of an employee to purchase shares of a company stock at a price before a certain date. And oftentimes, the benefit to this is that they're able to purchase shares at a lower price, which is usually the strike price or the grant price, which would be different than purchasing them at a later date when the stock goes up in value. As you look at these types of assets, there's four major threads that come out of it: value, vesting slash expiration, time slash term, and taxation. The other issue that comes up with this in certain jurisdictions is an apportionment of marital and separate property interest in the valuation of these two particular assets. So that's just sort of an overview of just general information. So let's start our discussion. with restricted stock units. And what are some of the main things that flow into the strategies that are involved in it? What would be the benefit of having it, and how are restricted stock unit values even determined? So for restricted stock units, the first thing that is important is the vesting. If you live in an area of the country where there's a significant number of technology activity in that area, you might have heard the term cliff vesting or something of that nature. So usually the average is sort of a ladder of vesting of 5 years for the employee to be able to take the benefit of that stock. And there are usually restrictions on leaving the employment at a certain time, which would either divest you of that stock or leave you with a lesser percentage of that stock. And the reason why this is important is because the value of this stock only happens at vesting. So we're not really looking at non-vested issues in terms of looking at income that's coming in to the marital estate. One thing to begin to understand is how restricted stock unit value is even assigned before we get to the other issues of taxation and whatnot. So the value of stock units is either done in one of two ways, either current valuation, and for companies that have accepted any type of initial level of venture capital funding, the value would normally be set at the price that the venture capitalist is paying for their percentage of that company. And so, for example, if venture capital was accepted for a company's valuation share at $50, and the current value of a restricted stock unit would be $50. The future valuation method, as you would imagine, requires a lot of uncertainty. You're looking at what the company is going to be worth at a future date, and you have to estimate that by looking at earnings and expenses, projected new investments in the company. And so if it is a company that is offering restricted stock units based on this valuation method, it is very important that this information be put out front to the employee. And when I'm doing the analysis on restricted stock units, I'm paying attention to how this is being valued so that I can determine the impact, if any, on my income and expense analysis on that. So the benefit of offering restricted stock units, and why one or the other spouse would take a job where this is a benefit, is that they're actually able to participate in an investment that doesn't actually cost them some money. The company, on the other hand, has the benefit of being able to attract employees and be able to not have to provide that compensation right away, as there normally is a ladder of vesting that happens over a period of time. Taxation is a huge strategy moment and a huge analysis moment with the restricted stock units. So what normally happens, for example, and I'm going to talk about a case in which that was the situation, and I'm going to talk about it from two different perspectives. But the general overriding principle for restricted stock units, as they are taxed at ordinary income when they become vested. What some companies normally do in this regard is they will pull back some of the vested shares in order to cover the potential taxes that will be involved with it. Now, as we said before in the overview, the value of restricted stock units, the fair market value is set at the time that they become vested. So an example of this is if an employee, for example, if one of the spouses is awarded 1,000 RSU stock units when they became employed, and then they remained in the employ of the company for the particular time period that is required for vesting, then at the end of that time period, that stock would become vested. If the fair market value on the date of vesting for those 1,000 shares was $20, then the taxable income that would be at stake would be $20,000, taxed at ordinary income rates, depending on the level of that income for the individual. So the taxation issue is a huge issue. The next issue that's actually really important is when these stock units were received, and were they received prior to marriage, and did they obtain value during the marriage and valuation after marriage? Did they vest during the marriage, but were they exercised after the date of separation? And when you have either a pre-marriage situation or a situation in which the stock units are vesting during the marriage, but then they're not being exercised, i.e., sold until after the date of separation, there are certain statutory prescriptions in various jurisdictions that allow a formula for determining how to allocate the marital and the separate property interest, i.e., are we looking at, was the stock issued as an incentive for employment, or was it to actually provide a different benefit in terms of retaining the employee or compensating them for something in the future? And depending on which one of those tracks you use will depend on what the figure will look like. For example, if the stock vested during the marriage but was not exercised until after date of separation. And again, if you had a pre-marriage distribution, so a family that I worked with at the end of last year, both husband and wife were employed with different tech companies. Their date of marriage was December of 2015. However, the wife was awarded two different grants of RSUs. One was designated as an appreciation grant, and the other was a promotion grant. And the market value of those shares actually increased during the marriage. And so that was a situation where I needed to calculate the appreciation of that vis-a-vis the cost basis per share and the date upon which those grants happened. So those are two of the issues that kind of could come up in a calculation zone for restricted stock units. Now, closely aligned to the subject of restricted stock units are stock options, but there are some differences in how this is approached, and the timing and the requirements for taxes and for holding periods are what sets the stock option argument apart from the restricted stock unit argument. And so the key analysis points that I focus on when I do this work are incentive stock options versus non-qualified stock options, an understanding of the compliance and the holding period with this, and the various taxation parameters that can be applied to this. So starting at the top, what is an incentive stock option? Well, in our overview, we talked about it is the right of an employee to purchase a certain number of shares at an established price, and it's usually less than the fair market value of that stock. And the advantage is that you do not report income on that stock option grant until you actually what we call exercise or sell the option. So as you can see, in contrast to restricted stock units, you are reporting the income at vesting for an RSU. For a stock option, for example, you would get on a specific date, which is known as the grant date, you would have the ability to purchase X number of units of stock. And so that would be what would happen. And so your key things there are looking at your grant date and your exercise date, when you're going through documents looking at stock options for families in an attempt to determine how that's playing into income. Is it going to be income that's going to be coming in later? How are we going to deal with it? Now, there are several ways that stock options can be exercised, and depending on which method is utilized, that's going to determine the taxation parameters and determine other issues related to tax as well. So, stock options are very much focused on what the individual is doing, when they're doing it, and how they're doing it. And so, today I just want to highlight a couple of those and then a couple of brief case references which actually highlight what that means. So, we'll talk about the first one first. Exercising the option to purchase shares and then sell them anytime within a calendar year. Now, that sounds like it pretty much should make pretty good sense, except for the following. What you want to take a look at is understanding what the holding period is. So, in our example, we're exercising the option to purchase shares and then sell those shares within the same year. So, in other words, they received them and they sold them. What is the compliance holding period requirement? If an individual holds the shares for 2 years from the date of the grant, which is the grant date, and 1 year and 1 day from the time they'd be able to exercise that stock, then the tax treatment would be at long-term capital gains for that transaction. And the capital gains is calculated primarily from the difference between the grant price and the price of the stock on the date that you sold it, along with some other attendant calculations. But that is how the capital gains comes into play. Now, a family that I was retained to work with last fall by counsel for the wife was a situation in which husband, without consulting with any other professional, just decided that a divorce was definitely on deck. I think it was shortly after the divorce was filed. That what he wanted to do was have available cash ready for whatever it is that they were going to need to do in terms of support and other expenses and other allocations in the marital estate. So, what he did within 1 year, so again, we're talking about the example of exercising options to purchase shares. So, he was able to actually do that. He was able to exercise those shares. And then he sold them within the same year. He did 3 different transactions within 1 calendar year. All right. So, unfortunately, because he did not meet the holding period requirement, and again, the holding period requirement is that you need to hold the shares for 2 years from the date of your grant date and 1 year and a day from the exercise date. He did not do that. As soon as he had the ability to exercise those 18,000 shares, he did them in 3 separate transactions of 6,000 shares at a time over a 2 month period and or a 3 month period for a total sale of 18,000 shares. What this resulted in for this family is the fact that, unfortunately, he did that before thinking about the tax impact. So that transaction for 18,000 shares did not receive long-term capital gains treatment and instead was taxed at ordinary or was going to be taxed at ordinary income for 2018, and calculations needed to be done with respect to the party's projected income for that year. But what ended up actually happening is he had a total tax liability from this transaction in the neighborhood of $90,617 and some change. He paid federal capital, he paid capital gains rates on ordinary income and state at ordinary income. So that was a significant tax effect. And sometimes these things, you're reading them after they happen, but they still impact what is available, what's going to have to be paid out of the marital bucket, and what's going to be left so that we can kind of determine where we're going with support and how that's affecting the standard of living. So it's really important to calculate these things out and see where they're going. So that's an example of in that 1 year. Now, one of the things that's very important with stock options is also the alternative minimum tax, otherwise known as the AMT tax. In a situation such as the example I used with the client example, where he transacted that within the year and did not um, wait a year and a day, the IRS has provided guidance on this in terms of when the transactions are within the year, then there is no necessity for tax preparers to apply the alternative minimum tax. It doesn't apply to this particular type of situation. Now let's contrast that with another way of utilizing um, stock options, and that's this example. So this example would be selling shares at least 1 year and a day after you purchase and at least 2 years after the grant date. What this gives you the option of doing is being able to take advantage of long-term capital gains rates. And depending on your income level and what other tax attributes are feeding into your taxable analysis. This can significantly reduce your tax liability and can put you in a position that's not quite as bad as the other example of paying a pretty significant price for having done those transactions ahead of time. One thing that would be important to highlight is that under this example of actually following the compliance and holding period, you will, however, need to take advantage, not take advantage, but be cognizant of the effect that the alternative minimum tax will have because that does apply in this type of situation. And so, how does this relate to what we're doing with the family financially, particularly when these types of strategies are being put into place? Here, you're trying to see what value is left, what value can be allocated, what has been sold, what type of investment assets it is, because they're treated differently. And again, I'm using the example of restricted stock units and stock options just to point out the fact that a lot of these different categories are treated differently, and it's important to recognize how that plays out so that when you're integrating those numbers into your calculations, you're doing that at a rate that reflects currently what could happen tax wise and whatnot, so that the families and council know how to deal with that. So, the marital real estate. I just want to just take a few moments to focus on this because it does come up and it does require calculation to see what the marital participation is, if any, in this type of scenario. So here is what the case would actually look like. There would be a situation in which real property was purchased by one or the other spouse prior to marriage. Post marriage, the other spouse is added to the deed to the property. And as the marriage continues to flow, payments are made on the mortgage and improvements are made on the residence, and things are happening. You take some time down the line, the marriage is now in a dissolution format. And now the question is, what is the marital participation in this? How is the marital estate affected by this? And how do we figure this out? And the analysis for figuring this out concerns the following data points. Need to identify the purchase price of the property and the amount of down payment that was made. That's your starting point. And a lot of times, parties may or may not have some of this documentation. So sometimes doing this analysis can be very challenging. But in any event, it is necessary to try to ascertain this information as a starting point. The issue of fair market value can also be one that is challenging, depending on when the home was purchased. I performed this specific analysis for a client about a year or so ago, and I'm actually doing one now for another attorney. So fair market value can be difficult to kind of pin down, depending, if the house was done a long time ago. Another issue that can significantly impact this is the issue of refinance. Last year, I was engaged to sort out this issue with a client who had performed a series of 2 to 3 refinances on this piece of property. And it was necessary to go back in time to come forward to figure out what was done in order to really sort of figure out the marital versus separate property allocation in that. Mortgage payments that are made, those need to kind of be determined. How much was put towards the mortgage payment by one or the other party? What did that look like? Appreciation for the separate property. Real property is always something that over time does increase in value, even if there are slumps or other issues that are affected by that. So we have to figure in what is the appreciation, what is the marital participation in that. Pay very close attention to work that needs to be done with multiple real estate properties and equity transactions connected therewith. Oftentimes, I've seen situations and worked on situations in which not only were there refinances done, but money was pulled out of one property in order to either invest in or purchase another property, and you're trying to follow that trail. And a lot of detail work and historical work is involved in setting the trail. But these are the various data points that actually come in to play with that and actually determine, do we have to compensate someone for that? Is that compensation going to take away from income prerogatives and what have you not? And that is how the real estate piece can come into play if that's going on in your client engagements. Another area that sometimes doesn't get a lot of attention, but I'm seeing it more and more, is the area of deferred compensation. And the way that this actually impacts the situation is to understand how deferred compensation plans differ and how they're managed and what the employee is in fact actually even able to do. So, in looking at it, the first point of reference is whether you're dealing with a qualified plan or a non qualified plan. And what do the statutes have to say about that? Your qualified plans are generally your 401k plans and 403b plans and things of that nature. Your qualified plans are generally covered by ERISA. And as a general rule, there are some limits to the amount of annual contribution you can make to those accounts. You're also generally able to, if you change employment, you're either able to roll those accounts over. A lot of times, if you are at the age of 59 and a half and over, some parties may choose to liquidate all or part of those accounts at a time when the tax and penalty prerogatives are not overhanging that transaction. In the area of deferred compensation, the most popular approaches to this concern non-qualified plans. So non-qualified plans are ways for your higher level executive to expand, if you will, their investment options. Why is this important for marital standard of living? Because it allows them to, that particular individual, to defer income in many different ways. And if income is actually deferred into another vehicle, then the ability for that income to be available to provide support in other marital allocation issues is very much compromised. The different ways in which salary can be deferred and contributed to are salary reductions, bonus deferral, and whatnot. And again, your higher level employee will probably be choosing this option, hopefully, in addition to a wide variety of retirement and investment options, because there are limits on how much can be contributed to a 401k account. And so this allows that particular individual to have another vehicle to put money by for the future. Contributions to that are generally looked at in terms of the standpoint that when the money is pulled down or when the money is actually accessed, that the individual will be older, will be at a different income level. And so the accessing of that money is hopefully going to have a lower tax effect. If you juxtapose this to a qualified plan, oftentimes those plans require required minimum distributions, or RMDs, at 70 and a half. And depending on where an individual is sitting income wise, that could present a bump up in income, which could have a taxable effect. Now, there are some downsides to the deferred compensation argument. And so if you have a situation, or if there's a situation existing in your client cases where there are some deferred compensation vehicles in place, it is critical to understand what the parameters of those are, if there's documentation on that. I frequently ask for that documentation to review that documentation, because the terms of how that money can be negotiated is very key to my MSOL analysis. The one thing that does come into play and is an issue is the issue of certainty with deferred compensation. Deferred comp plans for high level employees are generally not protected by ERISA. So they could be subject to forfeiture. They could be subject to bankruptcy of the company. It can, depending on the industry and depending on what is going on. It is not as safe a venture as maybe some other forms of saving and retirement. And so, in looking at evaluating a family's financial situation, if a lot of money has flowed in to those vehicles, that has a very, very profound effect on what is available. In addition, if there's going to need to have access to those funds, oftentimes there are restrictions on taking it out. Sometimes the money needs to sit there for a clearly identified amount of time and therefore is not available, and then therefore might not be available for additional support for a spouse who would need it. And the eligible participation, of course, is for high wage earners. And of course, we talked about that tax element. So you would really be focusing in this conversation, in this analysis, more than likely on non-qualified plans. And the due diligence and the strategy and the analysis, again, is to know what can be done and not done, how much money has been siphoned off and sequestered into other vehicles, what is the access to that, and how is that now going to affect the estate. So as we've come through, we've taken a look at restrictive stock units, RSUs, we've taken a look at stock options, real estate, and deferred comp. These are not some of the garden variety issues that come up with MSOL analysis, but they are certainly issues to know about, to be aware of, and to make sure that on behalf of your clients, the right analysis is being done in the MSOL report so that those numbers are verifiable and can provide guidance and security in coming up with a number for permanent spousal support. And so, as we close our presentation today, it is my hope that you've been able to get a little bit more of a window into this process and to understand the benefits of this process for your clients. And then for those times when other investment assets that tend to not be something that you've seen, to know that you can and should be on the lookout for any and all of those contingencies. It was my pleasure to be able to provide this information to you. My contact information is on screen. Please feel free to reach out to me if you have any additional questions or concerns. And again, I hope that this has provided yet another window of analysis that can be applied to your family law cases. Thank you for listening.